Dividend stocks have, as a class, generally been some of the best investments you can make, largely beating the market overall, particularly outperforming a lot of stocks that don't pay dividends. Here's the thing. There's a little known secret to finding the best winning investments that you might not be using when you're picking your dividend stocks. I'm Jason Hall. This is Investing Unscripted. I'm going to show you how to find the best dividend stocks to make your own market beating portfolio. Before we get to that, though, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should go to our special link. It's fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. You definitely need to check that link out. Okay, I'm going to bring up a chart on the screen, and I want to show you three different companies. I'm going to show you the dividend yield of these three companies, and I want to talk about what a lot of investors automatically do when they're screening stocks for dividend yield. We've got four different stocks. We've got, starting at the top, we've got Verizon Communications. Dividend yield right now is about 6.4%. Man, that's super attractive. Then we have a 3% yield for Coca-Cola, Starbucks, 2.3% yield, 0.52% yield from MasterCard. Chances are, if you look for dividend stocks, you might be using a dividend screener. Now, what's a screener? A screener is a tool. A lot of them are built into your brokerage account where you can use certain criteria and look to identify certain stocks. Maybe you're using a dividend stock screener and you're using yield as your screen. In other words, what it's going to do, you might pick a certain amount. Say you want to buy dividend stocks that yield at least 3%, arbitrary number that sounds pretty good. If a company is paying a 3% yield, it's not super high, but it's a good yield, and that's going to help juice your returns. So you set that, you run that screener, and boom, what happens? Guess what? Starbucks? Nope. MasterCard? Nope. They're not even going to make the list. You might not even be considering them because they didn't make your screener. Maybe you know about them, but you're looking for yield. You're leaning heavily into yield. You see that 3% yield from Coca-Cola. Hey, this is one of the greatest brands in the world. That's a Warren Buffett stock. Man, Warren Buffett loves to talk about Coca-Cola and all the things they do that makes him such a keen investor and shareholder of that company. Verizon Communications. Wow, they're one of the biggest wireless network providers. They've got their FiOS, big company, stable dividend, been around for decades. That's a pretty good one too, right? These are going to get really attractive. Then you're going to start buying your dividend stocks. A lot of people do that. They lean into that yield. They buy based on yield. Now, I want to talk about why that is the wrong number to look at. I'm going to use these four stocks. Yes, I cherry picked these four stocks. I did it for a reason. They're popular names. They're companies that have all done well. They're all well-established companies that are familiar, common household names. But I want to talk about how this one factor that you can screen for, that you can lean into, that's more important than dividend yield, can help you get better investing results. It's going to bring up another chart. So the chart that I'm sharing now, this is dividend growth. This goes back to 2012, the beginning of 2012. So we've got 13 years of dividend growth, a nice baker's dozen number, and a couple of things are going to leap off of the table at you. Number one, you see the massive, massive dividend growth at MasterCard. Now, it's a little misleading because MasterCard instituted its dividend party basically at the beginning of this period. So it went from the ground floor, grew its dividend the most. Then next we have Starbucks, 570% increase. Still pretty incredible. But again, same story. Younger dividend when it was started. Therefore, bigger growth. Now, Coca-Cola, Verizon, companies have been around for decades, paying dividends for a very long time. Verizon's a utility after all, right? Dividends are kind of baked into what they do. Coca-Cola, that's a company that's been around for more than a century, paying dividends for a very long time. So it makes sense they haven't grown dividends as much. But the point is, the two stocks that have grown their dividend the absolute most are still paying a lower yield than our two stocks that have lower dividend yield today, if you bought the stock today. Now, what difference does that make? Dividend growth is a secret supercharger for your total returns. I'm going to share another chart here in just a second that breaks down the difference in the total returns that investors have gotten out of these four stocks since the beginning of 2012. So here we are with our four companies again, going back to the beginning of 2012. MasterCard up 1,200 since that period. Wonderful level of return. And it kind of makes Starbucks' 397% in total returns look bad, which is crazy because 397% in total returns is a wonderful level of return. If we annualize that, we're talking about 14% in annualized returns, a number any investor should be ecstatic to get. And it pales in comparison next to MasterCard's otherworldly result. But the thing that I really wanted to stress here is then we look at Coca-Cola in green and Verizon in blue. These two stocks since 2012 have done vastly worse. We're talking 5.3% for Verizon and 7.8% in annualized returns for Coca-Cola. Again, not terrible returns. One could say they're modest returns, but far less than these other two companies. Okay, so what's the point that I'm trying to make? Like I said, I cherry-pick these companies. And the reason that I cherry-pick these companies is because of the results, because they highlight something that's really important when you're investing and you're looking to grow your total wealth. If you want to supercharge your returns, you don't want to chase the highest yield. Doesn't necessarily lead to the best long-term returns, as this video should demonstrate so apparently doesn't always lead to the best total returns, as I'm hoping that this video has demonstrated with 4 really great companies and 4 really different results in terms of total returns that they've generated for investors. Sure, if you're looking for guaranteed income, even sure, if you're looking for a high level of income and you want to have a high yield to get that income, maybe you're willing to trade that for return potential. But if you're looking to create wealth, as most investors should with your stock-focused portfolio, dividend growth is a far more important metric that's going to indicate the ability to get long-term total returns. Starbucks and MasterCard over this period of time were super early in their dividend implementation phase when this chart started. Verizon and Coca-Cola, far more mature companies, paying that higher yield, but growing the payout at a much slower rate because they were growing their profits at much, much slower rates, couldn't grow their dividend that fast. The key secret, the little known secret behind finding these dividend growth companies is typically companies that are growing their dividend at 10, 15, 20% a year, is they're probably growing their earnings 10, 15, 20% a year or even more. And you can find those high earnings growth companies by finding the companies that are growing their dividends at very high rates as well. So that's the little known secret right there. If you're looking to supercharge your portfolio, find more market beating stocks, stop chasing yield. Buy dividend stocks, find the dividend stocks that are growing their payout at the highest rates, then look at their earnings. And if they're growing the dividend because they're growing their earnings very quickly, then you'll know there's a very good reason to buy those stocks and hold them for the long term.